Happy Friday. Hope you're having a great week. Mortgage rates continuing to trend higher as it stands right now. A 30-year fixed rate mortgage in the mid to upper sixes. And I've got my eye on the 10-year Treasury note that last I checked here this afternoon is trading at 4.73%. And the T-bill getting over 4.6% for a sustained period of time really has, the last time that happened was in the 2005 to 2007 time period. And since then, the T-bill has been well under those levels. In 2023 and 2024, we briefly touched in the 4.8 range, but then it came back down. And in those years, we saw mortgage rates into the sevens and approaching 8% on a 30-year fixed rate mortgage. So I'm not saying that 30-year fixed rate mortgages are going to 7 or 8%, but it's definitely something to keep our eye on because although mortgage rates are not tied to the 10-year Treasury, they tend to track what the T-bill is doing. So what's driving this increase in T-bill rates over the last several weeks? Well, we've had energy costs move higher again. Oil's trading just over $90 a barrel. We have the long-term prospect for inflation feeling somewhat uncertain. We've got a new Fed chair, Kevin Warsh, and he's now had his second Fed meeting, and commentary from the Fed is shifting. Metrics that the Fed focuses on are shifting, and so the markets are going to need to see how the Fed handles the economy moving forward and what their plan is to bring inflation down over the long term. So that's going to create some uncertainty. And then last, we've got government borrowing. The government is on pace for a $2 trillion deficit this year. And when the government borrows money, they do that by issuing treasury bills, which are bonds, and that adds supply to the bond market. So the more supply there is in the bond market, the higher bond rates have to move to attract buyers. And mortgage-backed securities are where mortgage rates come from. Those are traded as bonds. We've got AI companies issuing corporate bonds. So there's a lot of supply in the bond markets, which pushes rates higher. So all of that putting upward pressure on rates for right now. We'll see where it goes from here.